Morning, Tony Virtue speaking, Virtue and Partners, and some better news on the economy over the last few weeks. So the GDP actually came in at 1.1 for the quarter, 2.4 annually, which was quite a lot better than what was expected. We're also through the earnings season and the half-year earnings, that is, quite a lot better again, 18% up on the previous year and higher than analysts' expectations. So what's driving this? Well, obviously the resources sector's had a good run, so your Rios, your BHPs, your Fortescues have done well. But in general, I think business is adjusting now to this new world, this digital economy, and we're beginning to see those results flow through. And ultimately that's reflecting on markets. Overseas, we see the Dow breaking 21,000 overnight. The Trump speech went down quite well. It was actually quite sort of calm. And whether we like it or not, the Republicans have got complete control over the whole process now. So a very high probability that what they say is what they will do. And markets kind of like that. The flip side of that is that as markets have improved, well then generally you'd expect interest rates to rise. Certainly in the US that may be as soon as March or April. See that as a positive sign, a sign of confidence. And just a bit of common sense with this, as markets do rally strongly, there will be a drawback at some stage, and a 10% pullback is not unusual. It's actually a healthy sign. I get nervous when things just keep going up and up and up, and you're waiting for that shoe to drop. So just be realistic about this. But domestically, things looking quite strong. We actually have now broken the Netherlands as the longest continuous run of good GDP numbers, 26 years. While we have our own challenges internally, many countries would love to have the opportunities that we do have. I think underpinning a lot of this growth, it really is the extraordinary development in technology, and that's good and bad. It's fantastic that we have so much knowledge now available on a mobile phone. The challenge, of course, is how do you manage so much information without getting into brain overload? And I can see that in our community at the moment, where we're just bombarded with information, and it's a stretch just for the brain to actually cope with it. Over time, that will settle down. We'll be a little more selective about what we read and who we read and listen to. For my reading at the moment, I'm reading Thomas Friedman, who's a well-known author from the New York Times. And just talking about this technology and how it's all evolving. So I guess self-evidently you've got Uber not owning any taxis, you've got Airbnb not owning any hotel rooms, you've got Facebook without any content, and basically the labour is coming from the public, but the markets are really supporting this, and it is driving efficiency. Overnight Snapchat listed for 35 billion as an example in the US. So look, the world is changing, and how we adapt to that and how we kind of filter this content is going to be a challenge for all of us. So let's just work within ourselves a little there, but this should be the best of times if we can get this right. Looking at the property market, which is of course a regular occurrence around here, it doesn't slow down in Sydney, and as you can see from the table, 18.4% supposedly for the year. We must be reaching a peak now. You can also see the rental yields coming down to a point where people are really investing primarily for capital growth. The reality is that people who've got their principal place of residence, and that's gone up substantially in value, they can sell that, they can move to a smaller place, they can use the proceeds to bump up their super to generate an income stream, and guess what, they haven't paid a dollar's tax in doing it. So we do have a distortion there. We have a distortion between Sydney and obviously other capital cities. Common sense would say over time this would even itself out, and places like Brisbane should be a beneficiary of this over time. The herd mentality, though, will mean that things will have to maybe have a few bumps down here before that will become completely self-evident. So look, I think it's a time where we should be reasonably confident. I think that we need to take the wins when they're there, understanding that markets will at some stage just slow down a little, and that's a healthy approach to take. We have our next presentation in a few weeks' time down at the Skiff Club, when we'll be going through a lot of the superannuation issues prior to year end. And again, as usual, there is more detailed information on the website. So do duck in there, and you can see what I have to say in far more detail. So look, that's enough for today. Good investing, and I'll see you next month.